and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Transat AT are seeing some pressure. Air Transat will begin canceling flights today and tomorrow after the union, representing more than 700 of its pilots, issued a 3-day strike notice. The strike could begin as early as Wednesday. The airline says the flight cancellations are part of a gradual suspension of operations to prevent passengers, crew, and aircraft from being stranded abroad. The two sides have been negotiating over the past week, hoping to reach an agreement before the deadline. Shares of Canadian packaging and printing company Transcontinental surging, that after the company agreed to sell its packaging business to U.S.-based Pro Ampac Holdings. The deal has an enterprise value of $2.1 billion, including debt. Transcontinental says the move will allow it to focus on the transformation of its retail services and printing and publishing segments. The deal is expected to close in the first half of the new year. Well, Montreal is hosting the G7 ministers to talk about artificial intelligence, quantum, and a range of key issues. The two-day event is part of a series of ministerial meetings with AI Minister Evan Solomon and Industry Minister Melanie Joly set to host. The gathering will have both an industrial policy agenda and a tech policy agenda. Now, in June, there was a joint statement on AI released by the G7 that said countries will work together to accelerate adoption of AI in the public sector to enhance the quality of services for both citizens and businesses. And looking at the markets right now, a little bit of red to start the week, and that's TSX ended last week, and right now it's off by about a quarter point south of the border. Red across the board, and similar range too. S&P 500 off by 0.4, Dow Jones off by about a half, and the Nasdaq down by 0.3 roughly. Well, all eyes are on the Fed and the Bank of Canada this week. Let's get more on what to expect from Kevin Hedlund, Co-Chief Investment Strategist at Manulife Investments. Kevin, thanks as always for joining us.
Thanks for having me.
What's it looking right now? I think the general consensus seems to be we're going to see at least a cut from the Fed, but and no movement from the Bank of Canada.
That's correct. Right now, I think the markets are fully pricing in a 125 basis point rate cut by the Federal Reserve. The key, I think, will be more so about the guidance and the minutes and the press conference that Chair Powell will be talking about. Markets are really whipsawing depending on this year what the expectation were Fed cuts. And in the next year, the markets are fully pricing in 2 additional cuts. And it'll be wait to see what the data says due to the government shutdown. Of course, we haven't had much data on the job front as well as inflation data. But going to next year, looks like still more cuts on the horizon. But markets, of course, want more cuts than perhaps the market is already pricing in. That'll be interesting to see. Bank of Canada definitely looking to be on pause right now. Although inflation is a little bit stickier, jobs data came in pretty solid last week. There's no reason right now, I don't think, for the Bank of Canada to look at either cutting rates or even think about tightening rates anytime soon. Again, they'll be data dependent, but I think the Bank of Canada will be on pause for quite some time, even into late next year.
And what are some of, are they doing this without the data down south of the border? I know that's been an issue. What are some of the numbers that they do have, and what are they looking at from them that may have an impact on the decisions?
Well, on the jobs front, there are other pieces of data come through, ADP reports, Challenger job cuts, JOLT survey comes out tomorrow. So there's still some indication of the overall economic landscape in the U.S. There is consumer sentiment as well that seems still very resilient. Again, inflation, again, stickier, not really a big major issue. And the jobs data seems there is a weakness in the jobs data, but also not much hiring. So we're kind of seeing this no hiring, no firing type of environment in the U.S., which, although it seems like it's benign, there's no reason to not cut rates right now. And I think this idea is getting rates down to a lower level from restrictive territory, which will just help alleviate some of the pressure perhaps down the road from where we have been at elevated levels for quite some time.
Now, it almost feels like there's no real one aha thing that could trigger anything here. It just seems like everything's just kind of going along like this, but nothing's saying yes or no, or where do we go?
There will be also some risks of having some dissent amongst the Federal Reserve members in terms of the announcement this week. There are some that perhaps don't want any cuts, some that want more cuts. So you're getting dissent on both sides of the ledger here because of perhaps the lack of information. It is, some would say, a Goldilocks environment. I wouldn't say it's hot, no, not too hot, not too cold. I think it's where it's a little bit cool, shall we say, but there's no reason why we should be worried too much about the overall economic landscape or a reason to cut rates faster than they are, but definitely no reason to keep them, as I said, as elevated as they were over the past couple of years.
And how much dissent will be acceptable to the markets?
I think it's really interesting if we average out to the middle. If you have one or two dissents on the other side, you kind of average right in the middle. The key is the markets want lower rates. That tends to be the fuel for the fire. It has been in the last couple of months when you have had this whipsaw of market expectations for Federal Reserve cuts. When there's more cuts priced in, the market seems to be enjoying that. When there's less, the market seems to not enjoy that as much. And this is where it'll be key, where Jerome Powell, I think, in the press conference, will talk about the need to reduce rates, but also to pay attention to the overall inflationary market going down the road next year, the resilient economy, no reason to cut rates too quickly. And the market may not be too excited about that, but I don't think they'll be too upset about it either.
And we're looking at a new head of the Fed. What kind of an impact will that have?
That'll be quite interesting to see who's going to be the lead of the Federal Reserve next year, as Jerome Powell is no longer chair after May. Of course, we talk about politicizing of the Federal Reserve and the pressure from the Trump administration, but we have to remember that the Federal Reserve decisions are made by committee. It's not one member. So that'll be also something to temper expectations. But as we get closer to that date, there will be more uncertainty, and I think the market will react to that uncertainty as well. So I would expect next year to see some choppiness in the early part of the new year for the U.S. equity markets. Not necessarily elevated volatility, but choppiness. This is one where we're looking at the markets with elevated valuation, some decent earnings growth next year. I think this is one where you want to be looking at quality companies, not trying to win every race to steal a Formula One reference from the race yesterday. But this is one where you don't have to win every race to win the championship, and that's key, I think, right now for equity markets and for investors.
All right, just one last question before we go. Talking about global PMIs, the global composite PMI you noted went from 53 to 52.7, kind of again floating along. Any concerns or headwinds that you're seeing with that?
Well, I think when you look at Manufacturing Purchasing Managers Index, this is a key where it's a survey of manufacturers around the world. 50 is your expansionary level, so anything above 50 is expansionary, below 50 contractionary. So at 52.5, 53, again, it's not too hot. It seems like it's pretty strong. When we look at this manufacturing data, it's a great sign to look at the trend of the overall economic landscape. The big issue we're looking for, and what many investors around the world are looking for, is the risk of recession. And given the manufacturing data, the support that governments are doing from a fiscal spending perspective, and what central banks have done from a monetary policy perspective, there's little indication that we are in a recessionary camp. I think we're going to get below trend economic growth around the world in most spots, lumpy data depending on the country. But overall, no fear of recession right now. I think that is also positive for equity markets over the next year.
All right, we'll have to leave it there, Kevin. Thanks as always for joining us. Kevin Hedlund is co-chief investment strategist at Manulife Investments. Up next, Paramount's Skydance is launching a $108 billion U.S. takeover bid for Warner Brothers after the company agreed to a deal with Netflix last week. We'll talk about that right after the break. Paramount Skydance has launched a $108 billion U.S. hostile bid for Warner Brothers after Netflix made news last week with its own bid for about $83 billion. Here to talk more about that is Julian Klimachko, CEO of Accelerate FinTech. Julian, thanks as always for joining us.
Hi, Roger. Thanks for having me. Happy Merger Monday.
I was going to say things just got interesting, but I think they actually got more interesting. What's driving this, do you think?
Well, before this momentous hostile takeover was announced this morning, 2025 was really gearing up as the year of the mega deal, while markets in the merger and acquisition environment got off to a rocky start in 2025 with the new Trump administration. It's certainly turning out to be a make M&A great again type dynamic where you've seen a massive surge in mergers and mega deals, particularly in the United States. And this historic takeover battle for Warner Bros. Discovery is kind of the final end to what's shaping up to be a record year for deals.
And what do you think is driving this battle? Is it there just hasn't been much?
Well, several things. So markets have stabilized, and boards of directors and executives are clearly very confident in the economic future. There's a deregulatory push that the Trump administration is implementing. Capital is flowing freely. The debt capital markets are fully open, as are equity capital markets. So raising capital for M&A seems readily available. And certainly with this deal, tens of billions of dollars are going to be needed. So it's a mix of equity markets doing well, debt capital markets open, financing available, and a regulatory regime that allows M&A to be struck. And it's to be seen whether these deals will be allowed from a regulatory perspective.
Which one do you think would be more likely to get through with fewer problems?
So this takeover battle for Warner Bros. Discovery is unique because Netflix, which has a friendly deal that they struck just one business day ago on Friday, they have an upper hand from a financing perspective and the ability to close this deal from an operating standpoint, just due to their scale and their size. However, from an antitrust perspective, Netflix's acquisition presents quite the challenge. I believe that since their pro forma market share in streaming will be 30 to 40%, a level in which the Department of Justice will certainly take a close look, and in my opinion, will likely challenge the deal to block it in court. So the Netflix bid faces pretty significant antitrust risks. On the other hand, the Paramount Skydance deal, you got to remember, this is an acquirer that's trying to buy a target that's nearly 4 times their size. It's a minnow swallowing a whale dynamic. And whenever you have that size differential, we're talking about the largest hostile takeover of all time, $108 billion, largest of all time by a long shot. In addition, the largest leverage buyout of all time. So with that comes financing risks and execution risks. And I think closing a $108 billion deal, or perhaps even going higher, because these two are now in a bidding war, that will be proven difficult for both parties.
And is this bidding war worth it to them? Who wins? Do filmgoers win? Does the average person win if Paramount gets it, or does the average person do better if it's the streaming that takes it over?
Well, this deal touches a lot of people. I think that Hollywood, specifically movie producers, and everyone in the entertainment industry seems quite concerned about Netflix acquiring Warner Bros. Discovery, because that has big implications for the box office and the movie theater business. Meanwhile, Skydance, they will probably be more friendly to Hollywood and the box office. So that's one of the strategic implications of their deal. And then from a consumer's perspective, there's not a lot of streaming services out there. Typically, people are looking at Netflix, Amazon, Disney, or HBO. And so if Netflix acquires HBO as part of this Warner Bros. Discovery deal, there's not a lot of additional choice for viewers and consumers for their streaming needs. So there's concern that the pro forma entity, if Netflix were to win this transaction, would be too great and they would have significant market power to further increase their prices. Now, Roger, I don't know if you're a Netflix subscriber, but I've seen my Netflix bill go up and up and up over the years.
Yeah, I think we've seen all of them go up over the last while. We're going to have to wrap it up there. And just Netflix is down today. Paramount is actually up with all this news that's going on. But Julian, thanks as always for joining us.
Thanks, Roger. Happy to be here.
Julian Klimachko is CEO of Accelerate FinTech. Coming up, we'll get an update on some of today's market movers with Bloomberg's Monique Molina. Let's take a look at some of the stocks that are on the move, going up, going down. We're going to be told which way they're heading by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us. And we'll start with those going down right now. Marvell having an off day.
Yes, thanks for having me. So Marvell, their shares are down this morning after Benchmark downgraded the stock to a hold. The company has had a number of deals in place with Amazon, and Benchmark is estimating that the deal for Amazon's design for Trainium 3 and 4, that Marvell might have lost that to one of its competitors. And this is something that investors and analysts have had a lot of hope for on some of these deals. So that's kind of weighing on shares that people think maybe that this might not be going through. Maybe it's gone to another company instead. And also they're expecting that the accelerator processing units, there's been a lot of growth in that segment, and they're expecting that to kind of slow going into next year and the couple of years ahead. There's also some investors who were hoping maybe Marvell might have been added to the S&P 500, but we saw on Friday that it did not happen, so that's also contributing to some of this decline as well.
Okay, next up, Strategy Inc., a Bitcoin treasury company.
Yes, so Strategy, formerly known as MicroStrategy, they're a Bitcoin treasury company, and their shares are up this morning after they announced that they had bought over $960 million of Bitcoin over the past week. This is their largest purchase since August, so this is a big move for the company in terms of adding to its Bitcoin holdings. They also announced that over the past week they sold over 5 million shares, so they're really becoming more aggressive in terms of their purchasing and in terms of their share sales to kind of increase their holdings. So that's why there's a lot of investor enthusiasm over this.
Okay, and last one we're going to get to Fluence Energy.
Yes, so Fluence, their shares are down this morning. They were downgraded to underweight at Mizuho, and they're a battery storage company. They do a lot of energy storage for data centers, a lot in kind of the AI data center space, and there's been a lot of investor enthusiasm on the hopes that there's going to be growth in this business. But the analysts at Mizuho are saying that maybe some of that enthusiasm and some of those gains that the company has seen has been premature. They think that there is going to be opportunities for data center growth, but it's just not there yet. Currently, a lot of data centers are still using gas rather than battery storage for their energy, so they think it's going to take more time to get there, and maybe the stock might have gotten a little ahead of itself.
All right. It seems like a real race for that when it comes to energy for those data centers. Monique, thank you for that. Bloomberg's Monique Molina. Coming up, the union representing Air Transat pilots has issued a 72-hour strike notice. We'll get the latest right after the break. Shares of Canadian packaging and printing company Transcontinental are surging after the company agreed to sell its packaging business to U.S.-based Pro Ampac Holdings. You can see it's up about 20%, 21% almost. The deal has an enterprise value of $2.1 billion, including debt, and Transcontinental says the move will allow it to focus on the transformation of its retail services and printing and publishing segments. The deal is expected to close in the first half of the new year. Well, we are watching shares of Warner Brothers Discovery, Paramount Skydance, and Netflix today after a new development. Paramount is now offering to buy the film and TV giant for US $30 per share in cash and has taken that offer directly to Warner shareholders. The move comes days after Warner agreed to a deal with streaming giant Netflix. Paramount says its offer provides shareholders with an extra $18 billion more than the Netflix offer. The offer is for the entirety of Warner Brothers, including its global networks segment. China's trade surplus for the year has topped $1 trillion for the first time. According to Chinese customs data, goods leaving the country climbed in November after a contraction the month before. For the year, China saw exports surge to destinations including Southeast Asia, Latin America, Africa, and the European Union. Meanwhile, shipments to the U.S. dropped nearly 29% year over year. The record comes as China has been diversifying its export markets. And speaking of the markets, a lot of red today right now to start off the week. TSX off by about 0.13%. Similar situation south of the border. The U.S. markets right now all down. S&P 500 off by 0.33. Dow Jones, similar number. For the NASDAQ off by about 0.2%. Well, Air Transat is starting to wind down operations with a full cancellation of flights by tomorrow after the union representing its pilots issued a 3-day strike notice. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. You get why the pilots are setting this as a strike date, but a difficult time for people trying to travel.
Yeah, not an ideal time. Anytime we see a strike this time of year, this time it's the airline. And this comes after about 38 years of relative peace when it comes to the labor force at that airline, at Air Transat. Yeah, so this is the first time we could be seeing something like this happening. Of course, the union representing about 700 pilots for Air Transat issuing that strike notice for Wednesday. So as you mentioned, flights starting to wind down today, halting either tonight or tomorrow morning for Tuesday in preparation of this 72-hour strike notice. The airline has called this premature. It is suspending flights today, as I mentioned, but for customers who are traveling within the next 5 days, just important to know before I get into the business side of things that you can get a refund if you are able to change or postpone your flight over the next 5 days. So that's just an interesting note for customers. But this comes at a time, of course, when the airline has been struggling, right? They've been in debt the last couple of years. They weren't before COVID, but of course, COVID took a toll on a lot of airlines, and Air Transat came out of that with a bit of debt. So shares down about 84% since 2020. And, they're still kind of trying to regain things, trying to pay off that debt. They had a big restructuring plan earlier this year where they managed to pay off quite a bit of debt, but still, struggling financially and also struggling with when it comes to control within the boardroom with some investors. I know we've been speaking a lot about Quebec billionaire Pierre-Karl Péladeau. He has been pretty vocal recently talking about how the number of board members within the airline is too big. He wants to cut it from 11 to 6 board members. He also wants to restructure the balance sheet. He's calling the situation deplorable, and he has blamed it on Transat's board of directors, which of course he wants to shrink to try to get things back on track financially.
So it's quite the background to have while they're doing these negotiations. And I think, was it 2016 the last time the pilots had a contract, I think?
2015.
2015.
Yeah.
And so what are they asking for?
Yeah, so they've been actually negotiating since January of this year for that contract, which, it was years ago, 2015. And so they haven't really provided exact details on what the pilots are looking for, but we know it's better pay and better working conditions, something in line with what Air Canada pilots received earlier this year. Air Transat has offered pilots a pay raise of 59% over 5 years, as well as, quote, major improvements when it comes to working conditions. Not exactly clear on what that means. But interesting to note, Air Canada pilots settled for a deal of 42% over 4 years. So that's a 10% increase each year for those pilots. When it comes to the Air Transat pilots, if they were to agree with this 59% over 5 years, that would be an 11% increase year over year. But still, both sides obviously hoping they can, continue talks and prevent what could be a strike as of Wednesday. But at this point, no word yet on whether that will be.
Yeah, very expensive strike this time of year.
Yes.
Okay, Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscaya. Now, for more on the potential impact of this, we sat down with Robert Kokonis, President and Managing Director at AirTrav.
Transat does indicate they are running a full slate of flights today, including some additional repatriation flights to bring people back. So the pull down of flights would start later tonight and all of tomorrow down to zero if that's where we go to.
So have you any handle on what the impasse here is? Is it pay? The pilots obviously say we want a similar deal to the Air Canada pilots.
Yeah, I mean, it always, with the pilots, it always comes down to the money. I think that the working conditions, other benefits, I think those are they're fairly close, if not already agreed. But it's money. And my fear is this, I mean, for ALPA and the pilots, they're almost coming to the big pilot contract bump, a little bit late. We saw the U.S. carriers, we saw the big Air Canada settlement for 42% over 4 years. Right now, because my concern is that consumer sentiment has been waning. We know that air travel is always the leading edge of any economic slowdown, and I'm concerned with the numbers I'm seeing that the pilots are willing to not agree to a substantive bump up over the 5 years, as you've noted, is quite concerning. So we're talking about a 59% increase over 5 years. A lot of that in the first year, and I might note their last collective agreement expired in 2020, and the pilots had 3 bump ups totaling 19% over that space of time. So 78% over the span of, let's say, 10 years is a very significant number. So it would be very, very unfortunate if the travel plans of Canadians and others would be interrupted by labor strife.
How strong a player is Transat? Maybe we could put up a 5-year chart. Are they reasonably profitable?
Yeah, I mean, they've started to turn a profit this year. That's great. And if we remember back in January, the federal government stepped in to provide some relief for the large enterprise emergency funding facility that was put up in place during COVID. Transat never really ran any long-term debt before that, and they really struggled coming out of COVID with that. So the federal government helped us slice a few $100 million off that amount. So that's great, more stable balance sheet. And they have been putting in some profitable quarters this year, which is great, but I wouldn't say they're out of the woods yet. Systemically, Transat's in the middle of restructuring the company from a vertically integrated holiday company where you had a tour operator, travel agency, and the airline was only fulfilling seats to one that's evolving into more of a network carrier, separate from the holiday package business. But make no mistake about it, the holiday business is still a huge piece. They're flying to over 60 destinations. They have 39 airplanes in the air right now. And it was one thing, let's say back in the summer, Air Canada flight attendants went out. Terrible to see people's summer vacation plans ruined. But this time of the year is a pretty special time for a lot of travelers going to see family, for example. So I think this timing is bad. I would also note as well, too, the 72-hour required notice under our labor laws, I believe, for a large, complicated aviation player, whether it's Transat or even an Air Canada, of course, much bigger, 72 hours is just not enough time to ensure we safely get all the planes and crews back where they should be grounded, but also all the airlines want to make sure they make an effort to repatriate travelers before potential shutdown. Bottom line, though, I feel still optimistic. A negotiated settlement is always preferable to a strike, and I believe that the parties were talking last night and continue to talk today. So let's hope the cooler heads prevail on both sides.
Will other airlines? Just remind me. What is their relationship with Porter? Because they are teamed up with that carrier.
They are, and it's been fairly successful so far. It's a fairly broad code-sharing relationship where the Transat code is placed on, or marketed, as we say, on Porter flights across North America, and Porter places their code on Transat-operated flights internationally. And so it's a fairly broad relationship, and it really gave Transat what they were missing, which was a feeder structure within Canada and even from the U.S. to feed those 2 big banks of international flights that Transat operates from both Toronto Pearson and Montreal Trudeau Airport.
Just a reminder, Transat is a lot smaller, obviously, than a player like Air Canada.
They are. I mean, as I said, the impacts of a flight attendant strike this past summer, there in Canada, quite significant. And Transat, with a mainline operation of maybe 220, 225 airplanes flying everywhere around the world, that was Air Canada. In Transat's case, much smaller, 43 airplanes, of which 39 are in service. And they're flying to a lot of destinations across the Caribbean, Mexico, even into South America. They've got a flight between Montreal and Lima, Peru. They're starting flights this December, I believe, to Georgetown, Guyana. They fly across Europe and points in North Africa. Now, some of those are seasonal, but they're still flying to 60 plus destinations on their own outside of the Porter relationship. Of the 60, maybe 15 aren't being flown right now that are seasonal summer, but it's still enough with maybe 10,000 some odd passengers per day. And let's say there was a shutdown for 3 days or who knows how long, that's a pretty significant impact, not to mention the number of people who will be impacted on the lead up to a work stoppage and then a recovery period after a work stoppage.
And he was speaking with Robert Kokonis, President and Managing Director at AirTrav. Coming up, we'll get a snapshot of what we can expect from the Bank of Canada's interest rate announcement on Wednesday. That's just ahead. Well, we are just 2 days away from the Bank of Canada's next rate decision, and earlier we were joined by David Doyle, head of economics at the Macquarie Group, who sees rate hikes ahead for the Bank of Canada in 2026.
There's a lot of factors that are supporting activity for Canada in 2026. In our view, of course, there's still a lot of uncertainty in terms of how things will play out, but we think there's a fair amount of cause for optimism. The uncertainty that has been plaguing Canada's economy, there's a lot of data that suggests that peaked in around the second quarter, around the time of Liberation Day in the United States. And as we look ahead, we think that, you're probably going to get progress towards a new USMCA agreement or CUSMA, as we call it here in Canada, at mid-year. And, that should further reduce uncertainty. Now, here in Canada, we might not love what that deal looks like, but even the fact that there's progress towards the deal and the range of possible outcomes narrows somewhat should support activity. And then you have some measures in the federal government's budget, such as immediate expensing of various forms of business investment that we think should be approved to be a positive catalyst. And now, as we saw on Friday, there's growing evidence that the labor market may be improving. Look, I think it's still early, and the LFS can be a volatile survey, so we don't want to put too much weight on it. But I think that there's some evidence there that things are improving. And then on top of that, at least that things aren't getting worse. And when you look at the shifts in immigration policy that are taking place, if you have an improving labor market, it won't take long for the unemployment rate to start to fall and fall pretty rapidly. And we could have seen, the first signal of that on Friday with the sharp reduction in the unemployment rate. So when we look ahead, we think the odds are skewed towards the next move being a hike rather than a cut.
That sounds like it would be tough, though, for Canadian businesses. If we're not cutting and America is, to tend to push up our currency, and then the labor market gets tight, so companies won't be loving it.
So, look, if the labor market gets tight, I would say that that's a good thing, and particularly for the Canadian people. For Canadian businesses, they might look at that and say, oh, well, now it's more expensive, it might start to get more expensive to hire people, but that's often another catalyst for business investment, right? And I think that that's an area that we should be, as a country, looking to, do sorts of things like we saw in the federal budget, the immediate expensing, to ramp up that business investment. We've been well behind the United States on that for 10 to 15 years. And I think that's a big reason why our productivity growth has lagged. And it's a big reason why our real GDP per capita growth has lagged theirs. So to me, that would be a very good thing. A rate hike in the context of a strong economy, I think would be fine, right? I think that if the economy is proving to be strong, then a rate hike, you'll be able to sustain growth despite the fact the BOC would be moving. So I don't think it should be proved to be problematic. I actually think it would prove to be a good thing when we see it in 12 months, according to our baseline forecast.
Do you think the vast numbers of temporary workers that Canada brought in under the former Prime Minister, was that just an easy out for Canadian businesses? They were able to just get away with lack of investment because they had all that cheap labor?
Yeah, I mean, yeah, I think that there was a cost to that. And the cost to that was, when you're looking at your mix of capital versus labor input, when you get a sudden impulse of labor, there is a tendency for businesses to lean more on that labor input. And I think we saw that. And I think as you look ahead, that policy is now reversing. And I think that'll be a good thing for Canada, a good thing for Canadian businesses, a good thing for the willingness or the ability to invest, right? And so what we need in this country is to improve productivity growth, improve GDP per capita growth to increase the standard of living here. And I think I'm more optimistic on that than I've been in over a decade, based on what I'm seeing. So I think that there is cause for optimism for Canada in 2026. And all of these policies I'm talking about, what we're seeing in the economy, the potential for a CUSMA deal, that's all part of the story from where we sit at Macquarie.
And David, leave us with a final thought. What about, I know you're a keen observer of the currency. Do you see a significant rally in the Canadian dollar over the next year if, as I say, the Fed cuts and Bank of Canada doesn't?
Yeah, so we think that the Fed just has one cut left, which we suspect will happen this week. And beyond that, we think that both the Fed and the Bank of Canada will likely be hiking by the fourth quarter of 26. So the policy rate differential, we don't really see as being a big driver in terms of our views. But, despite that conclusion, we're still, I think, quite optimistic on the Canadian dollar. We see it going, towards, in USD CAD terms, towards 131 or 132 over the next 12 months or so, which would be a sharp gain. And a big part of that, again, is just the economic environment that we're seeing, right? We think you have solid U.S. growth. Canada should follow suit. We think there's a lot of, I would think, negativity priced into the Canadian dollar based on the trade policy uncertainty. But if we're right and we get closer to a deal on CUSMA mid-year, that sort of weight or drag on the Canadian dollar should come out, and you should get, we feel a significant rally. So certainly we think more upside to the Canadian dollar than downside from here. And I think it's very possible that 2026 is a very good year for the Canadian dollar.
Wow, because 131 would be about 76 cents US for the Canadian dollar, and that's quite the rally.
Yeah, which is, by the way, it's still below purchasing power parity, which is I think around 80 cents. So, you could argue that there might even be more upside. We're not calling for that. We think our call is pretty aggressive as it stands. But I do believe that, that there are, there's this confluence of events that could take place in 2026 that could be positive for the Canadian dollar. And of course, that's only one side of the pair. The other side of the pair is that we see broad-based weakness in the U.S. dollar. So in that broad-based weakness in the U.S. dollar, we think, lends itself towards a stronger Canadian dollar.
Andy, we're speaking with David Doyle, head of economics at the Macquarie Group. Coming up, hot picks. We'll look at 3 plays in energy stocks when we come back. Time now for hot picks. Earlier, we zeroed in on 3 plays in the energy sector. We were joined by Stuart Glickman, analyst at CFRA. We kick things off with his first pick, Baker Hughes.
Baker is, prototypically known as one of the big 3 in oil services. Of course, oilfield services depends on upstream capital spending by the big players in the E&P space. The ConocoPhillips of the world, the Devon Energies of the world, and so on. And oil services right now does not look that great. However, Baker has another avenue going for it, which is its industrial and energy technology business, which is very well levered to 2 emerging trends or developing trends, if you will, probably through the end of the decade. One being LNG exports, liquefied natural gas, and the second being data center growth. So all those data centers require lots of cooling technology to make sure that everything's working well, turbines to have everything function properly. So Baker has exposure in those areas as well. And right now, Baker's revenue story or profile, if you will, is about 50-50 between traditional oil services on the one hand and this industrial energy technology business on the other hand. The backlog is rising. The margins in IET are really strong. And we think it's going to be a key driver for Baker for the next couple of years.
Wow, I wonder would they be tempted to do some kind of spin-off to, as you know, unbury the value. I forget what they express. Surface the value in
Unlock
that.
the value?
Yeah, go ahead.
So actually, it's an interesting question. They've actually done kind of the opposite. They have added to that, to their firepower in this area. They recently acquired Chart Industries, which gave them exposure, for example, into industrial energy technology that can be used in the mining industry, to which they did not have any exposure before. So it does look like they're using, they're intentionally diversifying. I think to be fair, the margins in IET are quite strong. So it's helpful to have that on hand, and it probably protects them to some degree if traditional oil services doesn't recover in the way they would like. So having that in your back pocket is probably a plus.
You have an LNG name for us, Cheniere. The LNG is even the ticker symbol, and they're a huge exporter.
Yes, Cheniere Energy, as you mentioned, ticker LNG, is probably the dominant player, the first mover in liquefied natural gas exports. So they are kind of a tolling booth for the industry. They have all the export facilities that will allow natural gas to be cooled, put on an LNG tanker, and shipped overseas to gas-hungry markets like Western Europe or Asia. And I think what Cheniere is benefiting from is that the U.S. is basically the low-cost leader when it comes to pricing for natural gas. Henry Hub, which is the U.S. benchmark, is somewhere in the neighborhood of about $4.50 to $5 per million BTU. If you look at similar benchmarks overseas, in Europe, the TTE is typically around the $11 to $12 per million BTU range. The JKM marker in Asia is in a similar neighborhood, around $12 per million BTU. So it does pay for these buyers overseas to pay for the shipping of that natural gas, move it from the low-cost place, and bring it over to their home markets. And there is certainly plenty of demand from both Asia and Europe. We don't think that's going to be changing anytime soon.
And then finally, Diamondback, another cute stock, ticker symbol FANG, was a Diamondback is a snake. What's the attraction here, Stuart?
Right. So Diamondback is a pure play in the E&P, in the Permian Basin. Permian is the workhorse of U.S. lower 48 oil production. We are not particularly optimistic about oil prices in 2026. They've averaged about $66 a barrel in 2025 through November at least. And for 2026, we're only projecting about $63 a barrel. I think what you have here, though, is you have a consensus expectation on Diamondback and on oil producers in general for 2026 that oil prices are really going to disappoint. The EIA is calling for about $51 a barrel next year. We think that's a bit too pessimistic. And secondly, Diamondback gets about 20 to 25% of their production in the form of natural gas. One of the problems that has been sort of chronic in the Permian Basin in the last several years is not enough takeaway capacity out of the Permian, and so that's weighed on pricing. But just recently, there's been an expansion in that takeaway capacity. There's more to come in 2026, probably through 2028, actually. And what I think this means is that realized pricing for natural gas for pure plays like Diamondback in the Permian, probably not going to be as pessimistic or as lousy as it's been the last couple of years. So we think that improves. And so our estimates for earnings power for Diamondback are better than what the consensus is at right now.
And he was speaking with Stuart Glickman, analyst at CFRA. A new report is calling into question the Carney government's plan to double the pace of housing construction in this country. CTV's Annie Bergeron-Oliver filed this report.
We need to get housing supply up. In fact, we need to double housing supply on an annual basis.
Prime Minister Mark Carney's campaign pledge to build nearly 500,000 homes annually so far isn't adding up. According to a new PBO report, Ottawa's new federal agency, Build Canada Homes, is projected to add 26,000 units to the housing supply over the next 5 years, a 2.1% increase over the fiscal watchdog's baseline projection for new home construction.
I think I would give them a C- when it comes to housing. That overall, I think they are moving in the right direction, but not at the speed and scale that's necessary.
The housing minister doesn't see things the same way. He says Build Canada Homes is just getting started and that the PBO's numbers don't tell the whole story.
I think that's just based on the raw number. It's not based on attracting a lot of investment from provinces, from the private sector.
By harnessing private and public sector funding, Ottawa intends to double the pace of housing construction. But so far, it hasn't released a clear plan to achieve that goal. And overall spending on housing, according to the PBO, is set to drop by 56% over the next 3 years as Trudeau-era programs expire.
A lot of the mechanisms that the federal government used weren't terribly effective in creating the affordable housing that people need the most. So I welcome the restart represented by Build Canada Homes, but we have to see a lot more.
The PBO report assumes that major programs like the $4.4 billion Housing Accelerator Fund will not be renewed or topped up. The finance minister, however, says it's not fair to prejudge what decisions the government will make between now and 2029. Annie Bergeron-Oliver, CTV News, Ottawa.
And thank you for watching Morning Markets. We'll see you back here tomorrow. Market Call is up next.